Are you or your limited company earning foreign income and wondering how HMRC tax it? Well, stay tuned to find out. Hi there, Nicholas Campion here from First Formations, the UK's leading company formation agent. The world is a whole lot smaller than it used to be. Thanks to huge advances in business infrastructure, technology and regulatory alignment, there are all sorts of new opportunities for enterprising businesses to make money trading overseas. And UK businesses do an incredible job at leveraging those opportunities. According to the UK government's Department for International Trade, nearly 1 in 10 UK-based SMEs are now exporting overseas to generate income. That activity represents hundreds of billions of pounds in exports. It also includes both limited companies and sole traders, and it covers everything from selling homemade goods on Etsy to providing business consultancy work in developing economies. But no matter which country you've been trading in, you'll probably be responsible for paying taxes on the profit that you make. His Majesty's Revenue and Customs, or HMRC, is the UK government's tax authority, and it imposes a wide range of rules on foreign income and how that overseas income is taxed here in the UK. If you don't pay taxes on eligible income, you could land yourself in a lot of hot water and be penalised. To help make sure that you're fulfilling your tax liabilities and avoiding tax penalties, we're going to quickly break down what kinds of foreign income HMRC taxes and how you need to report it. So how does HMRC tax individuals on their foreign earnings? If you are self-employed, you might need to pay income tax on the money that you make from trading in other countries. Those sources of income might include wages from abroad and income from foreign investments such as company dividends, the money that you get from rental payments on overseas properties, or cash from overseas pensions. Before we get into this any further, HMRC defines foreign income as any money that you make outside of England, Scotland, Wales or Northern Ireland. For tax purposes, the income that you generate in the Channel Islands and the Isle of Man is technically foreign. Now let's consider who is liable to pay tax on overseas income. If you are classed as a UK resident, you'll normally be expected to pay tax on your foreign income. The only big exception to this rule is if you are a resident in the UK but your permanent domicile is in another country. Currently, non-domiciled individuals are not required to pay UK tax on the money that they earn outside the UK unless it is more than £2,000 and it is brought into the UK. Now, according to HMRC, you'll be counted as a UK resident for tax purposes if you meet one of the following UK tests. You spend 183 days or more in the UK during a tax year. Your home is in the UK for at least 91 consecutive days and you visit or stay in the property for at least 30 days during a tax year, or your work in the UK is full-time for a period of 365 days and at least one day of that period is in a tax year that you're checking for tax residence status. Now on the flip side, you're normally classed as a non-resident if you spent fewer than 16 days in the UK, or 46 days if you have not been a UK resident for the previous 3 tax years, or you worked abroad full-time, averaging at least 35 hours a week, and spent fewer than 91 days in the UK, of which no more than 30 were spent working. That might sound simple at first, but some people don't fit into either category. Now don't panic if that's you, because HMRC has a relatively fair solution for that exact problem. If you move in and out of the UK a lot, HMRC may split your tax year into 2. This is called split year treatment. It means you're only expected to pay UK tax on foreign income during the time that you are actually living in the UK. If you're a UK resident, that means you'll be expected to pay taxes on both your income and capital gains generated both in the UK and in foreign countries. You don't need to pay UK tax on foreign income or capital gains if you've made less than £2,000 in the relevant tax year and you don't bring that money into the UK. If your foreign income or gains was £2,000 or more in the most recent tax year, you'll need to report it here in the UK. And you can either pay UK tax on all of it or simply claim the remittance basis. By claiming the remittance basis, you'll only have to pay UK tax on the foreign income or gains that you've brought to the UK. For example, if you've deposited the money into a UK bank account. You then won't be taxed on any money that is held outside of the UK. However, if you do claim the remittance basis, you'll lose your tax-free allowances for income tax and capital gains tax. You'll also be expected to pay an annual charge of either £30,000 if you've been a resident of the UK for at least 7 of the previous 9 tax years, or £60,000 if you've been a resident of the UK for at least 12 of the previous 14 tax years. Because claiming the remittance basis on foreign income and gains can be a bit complicated, it's advisable to contact HMRC first or enlist the help of a professional accountant. From April 2025, the remittance basis of taxation for UK resident, non-domiciled individuals will be abolished. And in its place, the government will introduce a new regime based on tax residents, which will be simpler and fairer. You can read more about this in HMRC's latest technical notes on changes to the taxation of non-UK domiciled individuals. If you work both in the UK and overseas, there are special rules that could save you money. You may qualify for the foreign workers exemption if you earn less than £10,000 from an overseas job, you earn less than £100 from non-employment sources of foreign income, such as bank interest, all of your foreign income is subject to foreign tax, your combined foreign and UK income is within the band of basic rates for income tax, and you don't have to complete a self-assessment tax return for any other reason. If you qualify for this exemption, you don't have to pay UK tax on your overseas income. You don't need to take any action to claim this exemption. If you're not so lucky and do have to pay UK tax, then you've got to report it to HMRC. Now, let's move on to how to report your foreign income to HMRC. If you are liable to pay UK tax, you'll need to report your foreign income from work or capital gains by filling out a self-assessment tax return. Check out our blog for guidance on how to register for self-assessment and complete your annual self-assessment tax return for HMRC. There are a few exceptions to this rule. For example, you don't need to complete a tax return if the only foreign income you receive is dividends, the total value of those dividends is under £2,000, and you do not have any other income to report. Income from pensions is a little bit different too. If you're a UK resident or have been resident in the last 5 tax years, you'll need to pay tax on foreign pension payments, early payments, or lump sums. To find out more about how payments are affected, it is worth getting in touch with your pension provider. One of the trickiest parts about generating foreign income is getting taxed by 2 different tax authorities, the country where you've made the money, and then again here in the UK. If the UK government has a double taxation agreement with a particular country, you might be able to claim for a tax refund with the relevant tax authority. You can get in touch with HMRC or consult with a tax professional if you think that you've been taxed too much in one or more jurisdictions. They should be able to advise if you're eligible to apply for tax relief or a refund. It's worth bearing in mind you may not get back the full amount of foreign tax that you paid. Now, so far we have covered how HMRC tax individuals. So let's take a quick look at how they tax limited companies on their foreign income. And in simple terms, UK limited companies are expected to pay HMRC tax on most of their income, whether it was earned here in the UK or in a foreign country. But as always, there's a bit more to it than that. All UK limited companies are required to pay corporation tax on all company profits. Currently, corporation tax is charged at rates between 19% and 25%, depending on a company's total profits. This means that for every pound that you make in profit, either domestically or overseas, you've got to pay a percentage of that in corporation tax. If your company is incorporated in the UK, you'll be expected to pay corporation tax on company profits generated from any number of business activities. And these activities might include buying or selling goods and services, leasing or buying a property, selling assets, interests or dividends, managing investments, and more. The same rules apply to a certain extent to foreign companies trading in the UK. If your company is based in another country, but you've generated income here in the UK, your foreign business must pay UK corporation tax to HMRC. But you'll only be taxed on the profits generated at UK branches or through UK activities. If you want to learn more about corporation tax and how it affects your limited company's foreign income, check out our blog, An Introduction to Corporation Tax. You'll find a link to this blog and other useful resources from First Formations and gov.uk in the description below. Just remember that tax matters should not be taken lightly. You or your company can be penalised for failing to report or pay your share of income tax or corporation tax on overseas income or profit that you make. You don't want to let that ruin your business. So if you've got any questions about how your foreign income is taxed, make sure that you get some answers. The First Formations blog is a fantastic place to get started learning the basics of UK taxes and how they affect your foreign earnings. But it is always best to seek professional advice. When in doubt, contact HMRC or get in touch with a professional accountant with knowledge of international tax regimes to make sure you are fulfilling all of your tax obligations for income generated both at home and abroad. So there you have it. That's how HMRC taxes foreign income for individuals and limited companies. If you have any questions, please leave them in the comment section below and we will get straight back to you. Finally, be sure to subscribe to our channel to get more tips and advice on limited companies, reporting requirements, tax obligations and more. We're always happy to help and we can't wait to hear from you. Until next time, cheerio.